The consumer and the economy go hand in hand. And here to discuss more is President and CEO of Wilsey Asset Management, Brent Wilsey. Brent, good morning.
Good morning.
You have broken this down in a very basic way. The consumer and the economy, the three biggies are consumer finances, residential real estate, and labor demand.
Exactly.
Okay.
And what happened was in 2022, we had a terrible market. The inflation destroyed things, and S&P down 20%. Well, now inflation is getting under control. Now we got to worry about the debt ceiling. We've hit that. Now we're concerned on what the government's going to do with that. But what I want to point out is that that's a problem. And I'm going to go back 25 years. We've raised the debt ceiling almost 20 times, or over 20 times. So we've been here before. It's not going to be a big deal. We're going to get it resolved. There's going to be a lot of hankering back and forth. We're going to get through that. So what I want to do is tell people, yes, you still should be investing in good quality investments at reasonable prices and give you reasons why things aren't so bad, because we only hear the negative side. And I'm talking about the consumer balance sheet. Now, I went back to the first quarter of 2009. The assets consumers held was $73.9 trillion. Today, it's $162.5 trillion, more than twice that amount. Those are the assets that people have across the country cumulative. Now, people worry now about, oh, the liabilities and so forth. Well, that's only $19.2 trillion, and 66% of that's in mortgages, which is a good debt.
Yeah.
So we hear the negative on student loans and credit cards. Compare that to the assets. The consumer's in pretty good shape overall. Mm-hmm. Now, also, too, we've heard about old people that are having trouble paying their bills. There's a thing called the household debt service ratio. Now, back in the fourth quarter of 2007, it was 13.2. Today, it is now 9.8%. So less than 10% of your income is used to service your debt. That's not bad. Now, it was lower last year, around 8% or so. Mm-hmm. So it has risen, but nowhere near these bad areas where people see them. And the last thing I want to point out about the consumer that's so strong is the excess savings. Now, during COVID, we had nothing to spend money on, so savings went way up. Right. It was about $2.1 trillion. We still have excess savings of almost $1 trillion that consumers have. Now, what that appears, and people pick this out, oh, the consumer's not saving as much. Yeah, because they're using all those savings from before, but they still have nearly $1 trillion to go into their savings to help make ends meet.
Okay, so that's the consumer angle. What about residential real estate?
Residential real estate is something that it has pulled back, I think, a little bit. I think there's more to go. I mean, we are seeing inventory start to rise a little bit. We are seeing people that bought another new home, can't sell their other home, so now they're sitting on that. That will have prices fall. But what I look at too is a rental vacancy rate, because that's very important. Before, people said it's better to buy a home than rent. That's no longer the case. It's much better to rent a home than buy one because they're so expensive. Rates are higher. So that we're seeing that increasing. But the big thing that has me worried for real estate is that multifamily housing starts is going above the average. The average over the last, 60 years is about 366 million starts. It's now at 584. We have a lot more multifamily homes starting to come online and will for the next year. And you go down 15, you see all these multifamily homes starting. What that is going to do is bring down rents, making people say, well, why should I spend all this money on a home when I can get a good home? And again, there'll be single-family homes plus multifamily homes that you can rent at reasonable prices, because the more it comes online, more competition, right, driving down prices.
Got it. Okay, the labor market.
The labor market is something, another reason I want people to feel good, because right now there's about 1.7 jobs for every job out there, for every person out there, which is a huge number. And you go back to the 70s, it's never been this high before. So we have a great job market. The other thing too, and this is why we won't have this major recession, is because people are more confident. There's something called the quit rate, how much people are quitting. Well, right now it's about 4 million people are quitting their jobs because they feel very comfortable getting another one. Now, it's not been that high going back over 20 years. So again, we're in another great situation there. And you do hear like, oh, Google's laying off and Apple's laying off. Oh, this is terrible and so forth. The layoff rate, going back also about 25 years, is an all-time low, about 1.3 million. So you have more people quitting than being laid off. So we have a very strong job market. We will get through the situation. You should not be on the sidelines, not investing, because look down the road 12, 24 months, and we will get through this debt situation with the government. They're gonna fix it. You're gonna have a lot of bad things come up about it. it's going to be fine.
All right, good to know. Any seminars coming up?
Actually, we just had one last Thursday. We won't have another one until April, so if people do
Okay.
want to find out more about us, we love sitting down, talking with people. They can go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. We just love talking with people, and we love the numbers, as you
I
can
know
tell.
you do. And the seminars are free, right?
They're free. Yeah.
Okay, good.
Cool.
Can't beat that. Free is awesome.
Yeah.